You better buckle up for a rug pull from the Federal Reserve because we just had some data come out and we've got inflation data and boy, oh boy, we got some problems. Let's talk about that. Do keep in mind today is November 1st, which means it is not only JPOW Day, I'll be covering JPOW live, but it is also the expiration of HouseHack's fundraise. The 2023 fundraise comes to an end for HouseHack. We've been waiting for this so long. We're so excited to close the fundraise. Go to househack.com. You have until the end of the day. Email us if you have questions at ir@househack.com, and funding closes tonight. So check it out for HouseHack. But folks, we got to talk data and we got to talk trajectory for the Fed's interest rate path. Because some are now saying higher for longer, maybe higher forever. Literally, look at this white line that I've sort of highlighted here with this box right here. Look at that white line. That is the Fed funds futures line. This shows you how high markets think interest rates could be going all the way out to December of 2025. That rates could be higher at over 4% for the next 2 years and potentially even inflect up at that point. That's because markets are now beginning to try to at least understand, is it possible that the neutral rate of interest could be higher? This is a fancy piece that Nick T tweeted out. It's basically a piece that says treasury yields have risen so much because markets are now suggesting there's a chance the neutral rate of interest, which is where the Federal Reserve is neither stimulative nor restrictive, could be a lot higher than it's previously thought to be. Previously, the neutral rate of interest was thought to be 2%. So if you kept interest rates at 2% as the Federal Reserve, well, then the economy would grow at about 2%. So economic growth being right arm, neutral rate being 2%. Rates 2%, economy at 2%. Great, easy. If you want to depress the economy, you take rates and you drive rates up, which should drive the economy to a slowdown. So you bring rates to say 4%, economy goes down to 1%. The problem is we've now risen rates to 5.5%. And what's the economy doing? It's growing at like 4.9% based on the last GDP read. And it should be down here. And now people are worried, okay, well, does the Fed have to go even higher? And is that going to actually drive us into a deep, dark recession? It's just a little visual for how you could try to understand the disaster that's going on. But that is the problem the Federal Reserve faces, is what do you do? Do you raise rates or not? Today, markets are expecting the Federal Reserve to hold steady for their second pause. That is based on the Fed Futures Rate Monitor. And we're looking at a 99% chance of that. But look at some of the data that came out this morning. This morning, we had the JOLTS read. JOLTS data came in at 9.553 million. That, once again, is higher than the 9.4 that is expected. That means, once again, the economy is staying more resilient. That's exactly what we're seeing in Nick T's tweeted piece here as well, where you have an economy that is providing more jobs. The 6-month moving average sits at 234,000 jobs. The 3-month moving average sits at 266,000 jobs. Our ADP report comes in soft again. ADP coming in at 113,000 versus the 150 expected. But remember, last time we got a soft ADP report of 89,000, we got this blowout 336,000 jobs for the actual jobs report. This Friday, we're expecting another jobs report. 180,000 jobs are expected. Problem is, we're starting to see multivariate core inflation trend up. This is calculated based on the Fed's favorite inflation numbers, which just came out a few days ago. It's PCE inflation. They don't like to go by CPI, though everybody watches CPI. Anyway, they calculate together this graph, which this graph here is sort of your probability band of where inflation probably is. You can see it's very volatile. Even when it goes down and it's trending down, it has periods where it goes up. So that's very normal that it feels like it has many inflection points because it's a very volatile graph. We've had a very great January to like July, September of 2023, where this has basically been straight down. The problem is now it's doing a little bit of a tick up here, which could be very well part of just the volatile nature of this chart. Again, you go out to the 70s, you see almost exactly the same thing here, the mid 70s. Here's the Paul Volcker era, right? Even during the Paul Volcker era, you saw this band move up occasionally. You saw it here, you saw it here, you saw it here, you see it right here. And that didn't necessarily mean long-term trends were breaking back up higher, right? We don't actually highly expect that inflation is going to rip up again, though there are some people who say, Kevin, you're wrong. And I very well could be. Maybe inflation will resurge. It's not what we're seeing in company earnings calls. It's not what we're seeing in company earnings. Either of those. Both of those are indicating declining volumes and that prices are going to have to fall for goods and services to continue driving spending. Unfortunately, the rearview mirror data, like Q3 GDP data, suggests people keep spending. Services and goods consumption rising in Q3. Residential investment increased for the first time since Q1 2021. That's mostly driven by home builders. So you have a very strong economy, and it's one of the reasons you're seeing this drive up in yields. Unfortunately, these strong numbers are great on one hand because it means the economy is doing well, but on the other hand, it keeps interest rates, again, higher for longer, and that's likely what we're going to hear from Jerome Powell today. I think Jerome Powell needs to be very hawkish in his pause today. I would not be expecting any kind of, hey, we're going to cut rates soon. People are going to ask him these questions. He's going to dodge them. He's going to look at this particular chart right here, and he's going to say, look, we're going to go with a hawkish pause. We'll pause. Maybe he'll even tell us. He probably won't, though. There's a tiny chance, like a 2% chance he'll say, we're done hiking. Now we're just going to sit here. I think he's going to be very clear. We're keeping the door open to more rate hikes. They have to fight this curve down to below 2%, which is that line right here. That bottom line, look at that. We're not there. We're not even close yet. We have work to do. We could zoom out here and kind of see pre-COVID for a moment. This is where we got to get back to. We were getting close to it, but now the trend is going back up. So we're going the wrong way. I mean, look at that. At the low, we were at about 2.19% to 2.96. That was the band spread. And now we're sitting at 2.4 to 3.28. Gotta push that down. You know, you want it to kind of be like where we were in the past. Where, I mean, look at in the past, it was like 1.5 to 2%. This is why your trend was below, right? You were having inflation below trend. So anyway, Jerome Powell today, I do not expect is going to be very enthusiastic about suggesting rate hikes are over. He's going to tell us that more rate hikes are a possibility. We're pausing, but we're attentive to inflation rising. This is not going to be a bullish pause. It is a hawkish pause that's coming. We'll create a bingo card, and we'll go through that when it's bingo time, which will be in about 3 hours. It's about 11 a.m. Pacific time, 2 p.m. Eastern, that we will be covering the event live. So make sure you're there. In the meantime, go to househack.com, email us at ir@househack.com if you have questions. Thank you so much for watching.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Now I have to read you a legal disclaimer. Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient for the purposes of evaluating a security or investment decision. Any links to promoted products are either paid affiliations or products or services we may benefit from, like my courses or my actively managed ETF, which you can learn all about at meetkevin.com. I do personally manage an ETF and I do hold various long positions.